Alright traders, welcome back here. Have you heard of the word liquidity purge and revert? Well, this is something I want us to discuss in today's video because I've gotten a lot of questions concerning this particular topic. And I told you that if you have any question, you can let me know in the comments and I will take time and make a video explaining it. So let's go into explaining what exactly is liquidity purge and revert. Now, before we go into that, what exactly is liquidity? This word liquidity, every smart money trader, liquidity. Let me give you the simplest definition of a liquidity. Liquidity simply means money. Why is it money? Because look at this. The driving factor in this market is liquidity. The smart money are here because of liquidity. The retail traders are here because of liquidity. All the institutions are here because of liquidity. Everybody is after money and price moves in the direction of money. Where money is pumped is where price will go to. That's as simple as that. Now, how do we translate it into trading term when we say money? Now, let me show you an example. Let's assume you're putting or you're taking a trade here. You're going bullish from here. Somewhere around here. All right, and you're putting your stop loss here. You're putting your stop loss at that area and your target is here. Just an example now. I just want you to understand this thing I'm explaining. So if your entry position was at $100, you wanted to buy something, you bought it at $100. What do you think your stop loss will be? Let's give it a scale. This is 100. This is this is that, and this is that. So at every calibration of this could be, let's call it $80. Let's call this $120 and this $140. So the only way you can sell something is when you find an available buyer, and the only way you can buy something is when you find an available seller. So if I buy this particular product at $100 here, and I said, okay, it is possible for price to go lower than the price I bought, which is $80. I don't want it to go further lower than this because price will keep going low depending on the forces of demand and supply. All right. So if price is to come down to $80, I want to sell it at $80 as opposed to my intentions to sell it at $140. The only way you can get rid of what you have bought is by selling. So your stop loss is simply saying you are selling at $80 as opposed to the $100 you've bought. And your take profit is also a sell order. But your take profit and your stop loss when you are buying is a sell order. Because if you buy here, to get rid of it, you have to sell it. If you buy here, to get rid of it, you have to sell it here. All right. So this is the simplest definition of liquidity. So if you are in the market, here comes the trickiest part of it and why many traders get into trouble. If you have price range just like this one I explained to you, if you have something here, at this price is 100, at this price is 80, at this price is 60. If you have money, which one would you buy? Which one would you buy? Is it the 100, which is expensive, or the 60? Which of them? Obviously the 60. That is why the smart money target your stop loss before they take price up. They want to buy it from you very cheap. Do you understand? So when you see a high, normally what people do is that when they enter a trade here, let's say we are going bearish from here. When they enter a sell from here or somewhere around here, they put their stop loss just above the high because they believe that is where price should not go to, and they target somewhere there. And if the smart money wants to start their own, they will start by buying it from you or selling it for you. The same way it goes like that. Because higher price here is a bit expensive. If it is a sell order they want to take, they want to sell it for people that are willing to buy at top. Now, the same scenario goes for the opposing side. Let's say this price is 120, this price is $80. So if you want to sell to whom are you going to sell? The guy who is willing to buy at 120, of course. That's why they go for your liquidity. They go for the highs. So every high and low has liquidity resting below it and above it. So they sell and quickly allow price to go lower so they can buy. They buy low, they sell high. Sell high, they buy low. It's the same thing that happens. So now coming back to liquidity, Purge, and Revert. So quickly, guys, before I continue with explaining what I'm already explaining, I want to introduce you to FastBull. FastBull has a trading contest coming up in the next 18 days. And you know, one of the beautiful things about this particular trading contest is that it's going to be free, completely free for everybody, equally chanced. So all you need to do is to use the link in the description of this video and register and preserve your seat for this contest. Let me show you the prize pool for all the winners. The first winner is going to go with $10,000 cash, and then the second winner is going to go with $5,000. The third is going to go with $3,000. These are the prize. Up to the 10th position is going to have something given to him. Now this is fastbull.com, and they also have an amazing platform called the FastBull chat platform. If you come to fastbull.com, all you have to do is go to products and come to charts. The charts on fastbull.com is similar to TradingView, but one of the standing factor here is the fact that it is free forever. You can have access to tile it. That means to arrange it in different segments, just look like you can see right here. So if you want to check fastbull.com, try and check it in the link in the description of this video, and it's going to be in the first comment of this particular video. Please don't hesitate to participate in the contest. So let's see an example. I said an old high or old low has high liquidity pool area resting around it. So this place from here, you see, from this week up to this area is all full of liquidity pool, starting from where there is little concentration of liquidity to where there is high concentration of liquidity. Mostly above the high is high concentration of liquidity. So when you see this, let me even put it as liquidity pool text. Let's call it liquidity pool so you can see it. All right, this is liquidity pool. Correct spelling should be done, obviously. So this is your liquidity pool. So smart money are coming to sell for people that are buying it very expensive. There are stop losses for the sell order they took the last time was above all this area. And the stop loss, if you are selling, your stop loss is a buy order. The same thing. All right. Your stop loss is a buy order. Are you understanding what I'm saying, please? So look at this. If price is done with external liquidity, what do you think price will do? After clearing liquidity, price will look for where they will find a cheaper price to buy again. They took from low to high, selling it here. They allow price to come back again. So liquidity purge, which is liquidity sweep, liquidity raid, and revert. Now what I want to teach you is how to take advantage of the revert when price is coming back inside the range. I hope now it's making sense. So after price has cleared liquidity, this is the daily time frame. I'm going to show you the exact data you should focus on, how you should do it. After you see price clears liquidity, key area now. This is the daily time frame. What we normally do is to drop from the daily time frame to 1 hour time frame. Or if you are comfortable with the 15-minute, you can do the 15-minute time frame. And then I will show you the amount of data you need and how much data you should focus on. But before then, you should also make sure that you take cognizance of the price range. This one, here to here. This is the price range we are dealing with. So most of the time, price will revert into at least the equilibrium point of this movement. The equilibrium point of this movement. So let's put our delineation there. So we are sure of this price movement, the equilibrium point. You see, premium and discount. The equilibrium point is half of it. So price will either move to the equilibrium point and continue upward or downward here, just to give a fair value. I hope you're understanding this. Don't worry, when I go into the deepest part of this, you will understand. So once I see this now, I will drop down to the 1 hour time frame. This is important. Dropping down to the 1 hour time frame. Here you are in the 1 hour time frame. What do you do next? After dropping to the 1 hour time frame, where is it? Let me see. I hope this is the right place. Let me go back and mark it, delineate it correctly before I come back for that. Okay, this is it. This is where we have the liquidity purge. So the 1 hour time frame will give us that exact point also. So let's see it at that exact point. Beautiful. Beautiful. So look at this. The day you have the liquidity purge, after that daily candle has printed VAD, take your period separator. This is period separator. These vertical lines, you can activate it. The number of data you should focus on, or where the next sell side liquidity will be resting, is important. So what you will do is pick your line and make sure that you take all the lowest area of the previous days. This is the lowest area price went on this particular day. The lowest area price went on this particular day at least 3 days back. All right, 3 days back, the lowest area, and here the lowest area that price have created, the low of that day. 3 days, right? 1, 2, 3. Starting from the day price have purged liquidity. So these are the liquidity targets that price may most likely reach to. Let me show you. If you're doing swing trades, this is going to be very, very handy for you. The lowest area was here. All right. So these 3 liquidity levels are the areas price may most likely go to. Style, let's go extend to right. Extend to right. No, extend to left. Perfect. These are your targets. These are your targets for price movement. These are your targets for price movement. Now, how you can frame your trading idea with this is the next question. Now pay attention to this. You start from after price have swept liquidity. The day price have cleared liquidity, mark the lowest area. If you are dealing with a bullish scenario, mark the highest area. You need price to clear the low before you start taking your sells. The low of that day, you need price to clear it before you start taking your sells. So on that same day, the next day price have now cleared the lowest area. This was the lowest area price went to. You can literally see this was within the dead hour, so I don't want to pay attention to that. So immediately the next day, so you need to have so much patience to be able to take this kind of trades. So the next day price have cleared the low of that liquidity sweep. Now you can start framing your trading idea, targeting where? At least the low of the third day, starting with the equilibrium point of that price range to the low of the third day. You can see price went to the lowest area there. So you can see it. And this is the equilibrium level. It even went lower to discount. All right. But targeting the low of these 3 days is important. This should be your targets. So the first day, after price have closed below the low of the sweep of liquidity, you have another thing called a break of structure here. This is a break of structure. Let me adjust this so you can see what I'm saying. All right. Sorry. Let's have a look at it here. No extension, right? Boom. So this is a break of structure. This is a break of structure BOS. While this is in form of what we call a shifting market structure also. Price have cleared this shifted structure. Now you have a trade idea. Is this not an ultimate trade entry? The moment you have a trade setup, if you take it, that is your swing trade. Are you understanding what I'm saying? That is your swing trade. Price coming back to institutional order flow entry drill. Institutional order flow entry drill. you have a low and a fair value gap rightly placed in these. So here is your entry for a swing trade. Massively. You're taking this, your stop loss can be refined here. And you're going to target the low of the third day. All right, this is the low of the third day first. And to even give you a better idea, the truth is that you can reach the equilibrium level. It is sure that you will have the equilibrium level of that price. The moment price takes out this guy, I just want you to go to your chart and practice and see. On the daily time frame, look out for a liquidity purge. Come down to the 1 hour time frame, look out for the particular day that price have swept liquidity. If price close below it, you're going to see that price will trade back into the equilibrium of that price range. This is how you can take liquidity purge and revert, purging outside external liquidity and coming back into internal range.